Hello and welcome to the webinar. My name is Julia Kislitsina. I'm your moderator today. As we wait for more viewers to join, I'd like to provide some technical information about the webinar. We will have a Q&A session at the end, but please feel free to send your questions using the chat options at any moment. We are running a poll during the webinar, and you can take part in it by selecting your answers on the right side of your screen. We will show the results of the poll shortly before the Q&A starts. This webinar is recorded and will be distributed along with the presentation slides within a few days. Today, we're excited to introduce the EU Environmental Reporting Handbook. Jointly produced by CDP and CDSB, the handbook provides examples of good practice environmental corporate reporting in line with current European requirements. Now, just recently, new research was published by Alliance for Corporate Transparency, and it revealed some unsettling data in terms of ESG reporting in the European Union. According to the research, less than 14% out of 1,000 companies align their climate targets with the Paris Agreement goals of keeping global warming well below 2 degrees Celsius. And while roughly half of companies recognize the existence of climate-related risks, just around a quarter provide specific information that allows readers to understand the climate-related risks that they are facing. And while we are still far from best practice, CDSB and CDP were able to identify and analyze examples of corporate reporting that can be considered good practice. To guide us through some of these examples, we are joined by CDSB's project manager, Gemma Clements. Miriam Wolfram, Director of Policy Engagement at CDP Europe, is also joining us today to provide background and context to the policy movements around the revision of the European Non-Financial Reporting Directive, which is very important to consider and keep track of for anyone disclosing environmental information in the European Union. With that, I am happy to hand over to Miriam.
Thank you very much, Julia. So my name is Miriam Wolfram. I'm Director of Policy Engagement at CDP Europe. I give you a very brief overview of CDP Europe in numbers to give you a little bit of context towards our analysis. So we do have by today more than 2,100 European companies out of 8,400 companies globally using the CDP data system, disclosure system to respond to their investors. We have 300 investor signatories out of 525 investors globally, and those in Europe represent about 35 trillion in assets supporting the disclosure request to companies. This is along with a number of cities, states, and regions, which is not the subject of today's webinar, but it's important to highlight. And we do have a 76% of European market capitalization of the companies using the CDP platform. A very brief overview of how we do engage with policymakers. So this is roughly along the lines of providing expertise, analysis, and capacity building to policymakers across EU legislators and national ministries. And to give you some examples, we are a member of the European Technical Expert Group on Sustainable Finance, of the EU Eco-Label Stakeholder Group, and also of the German Sustainable Finance Advisory Group, along with a number of capacity building groups, so to say, which is the membership of the EFRAG, European Reporting Lab, and stakeholder groups at EIOPA. So let's have a look into the key features of the current non-financial reporting directive. And I'd like to start with the what to report. So the directive on disclosure of non-financial and diversity information, the abbreviation is then the NFRD directive, requires certain large companies to disclose information. More specifically, the NFR directive requires these companies to disclose information on their business models, policies, risks, and outcomes as regards to environmental matters, social and employee aspects, respect for human rights, anti-corruption and bribery issues, as well as diversity in their board of directors. The NFRD directive is an amendment actually to the accounting directive. And just to give you a little bit of context where this sits within the European Commission, the Accounting and Non-Financial Reporting Directive is led by the Directorate General FISMA, that's Financial Stability, Financial Services and Capital Markets Union, and more precisely by the unit Corporate Reporting, Audit and Credit Rating Agencies. So the directive requires to report a brief description of the business model, a description of the policies pursued in relation to those matters, including due diligence processes implemented, the outcome of those policies. And on the next slide, we see the other two elements, which is to report principal risks related to those matters, and non-financial key performance indicators relevant to the particular business. The directive is accompanied by two guidelines on non-financial report, two non-binding guidelines, so to say, that support the companies to understand what they have to report under the directive. The guidelines on non-financial reporting, you see on the left side, had been published in 2017. And as they were actually a requirement by the directive, and the objective is to help companies disclose relevant non-financial information in a more consistent and more comparable manner. You see the elements of those first set of guidelines, which I'm not gonna read out. Those first guidelines from 2017 had been supplemented by guidelines on reporting climate-related information published in 2019. Those guidelines that you see on the right side are based on the report from the Technical Expert Group on Sustainable Finance and the subgroup Disclosure Metrics, to be precise. The guidelines provide a set of KPIs on climate-related disclosures suggested by the the Technical Expert Working Group, the abbreviation is TAG. They also explain the double materiality principle the European Commission applies. That is quite important to note because the Commission is has a very strong stance on how they view materiality. In addition to the TCFD, to the Task Force on Climate-Related Financial Disclosures recommendations, these guidelines also take particular account of the standards and frameworks developed by CDP, the Climate Disclosure Standards Board, the Global Reporting Initiative, the Sustainability Accounting Standards Board, the International Integrated Reporting Council, and the EU Eco-Management and Audit Scheme. Let's look into where to report. So the information, the non-financial statement, shall be included in the management report or the consolidated management report of companies. Shall include references to the amounts reported in the consolidated financial statements. There is no specific requirement on where the information should be disclosed, however, in the annual report. So the directive allows to have a separate section in or throughout the annual report. And companies, as this is a directive, member states had flexibility in the transposition, and companies are required to comply with applicable national legislation. So to sum up the reporting non-financial information in annual reports obviously allows investors to assess the relationship between specific non-financial matters and an organization's overall strategy, performance, and prospects. And as a result, a more holistic picture of the interrelationships between factors that affect their ability to create value is provided. I would like to move now to give you a little bit of oversight of the scheduled revision of the non-financial reporting directive. The timeline is you can see on the slide, has already, the Commission, DG FISMA, has already started by publishing a roadmap on a inception impact assessment, which is actually currently open. And this public consultation will close on the 27th of February. They will then launch a consultation on the revision of the non-financial reporting directive. And this public consultation should actually open every other day. It might actually open later today even. And I think the timeline for this consultation should be 2 to 3 months. They will then publish the results of the Inception Impact Assessment and a previous consultation they did and called a fitness check on the EU Corporate Reporting Framework, which goes beyond the Non-Financial Reporting Directive and looked into all different EU corporate reporting policies. Those two results are expected to be published before the summer break 2020. And then finally, out of all of this, the Commission will table a legislative proposal on the non-financial reporting directive towards the end of this year. This is obviously a suggested timeline. There can always be changes. So ultimately, you have always to check also on the Commission's website. Let's look into the revision elements they have in mind. So they very much go along the lines of ensuring and strengthening comparability, reliability, and relevance of data. And you can see that there is a number of elements in the directive which the European Commission will specifically tackle. And this is then also obviously to be confirmed once the public consultation will be published every other day. So again, also please take this just as a guidance from our understanding at the moment. As I said, materiality, the European Commission applies a double materiality understanding, which means that they want to capture through non-financial reporting of companies the impact of companies on climate and environment and other social matters, as well as the impact of climate change and environmental degradation on companies. So that is the financial impact on the companies. They want to strengthen the assurance of information, and the non-financial information reported in the future shall be subject to an audit equal to audits of financial information. So going beyond auditing the existence of a non-financial statements towards actually auditing the content of the non-financial statement. The comparability, as I said, is a key element. They could take as one of the elements to ensure this an introduction of sector-specific KPIs, maybe along the lines of must, should, and could KPIs. They will look into the scope of companies covered. It could be subject to revising the number of certain thresholds. One of them is the number of employees of companies. It could also go towards the legal form, but again, this has to be confirmed ultimately by the Commission. Location of disclosures is important to mandate publication in the management report. And to not allow for later publication in other places is probably key to the Commission's thinking. And ultimately, they have also to ensure coherence with other policies. And this is notably the EU taxonomy on sustainable business activities and the investor disclosure regulation. And ultimately, the regulatory framework will also be complemented by European standards on non-financial reporting. So I come to the end of my presentation, and I would just like to briefly talk you through how the CDP disclosure system currently supports companies to report under the Non-Financial Reporting Directive. So companies use their disclosures to CDP as the basis for non-financial reporting requirements and for reporting against frameworks such as CDSB. CDP's standardized questionnaires ensure consistent and comparable information in one platform that allow aggregation and comparability across companies and jurisdictions. CDP data cover climate and environment, and among the ESG reporting requirements, which is actually the scope of the non-financial reporting directive. And our questionnaires are aligned with the recommendations of the Task Force on Climate Financial Disclosures. climate-related financial disclosures, excuse me. CDP data are used by companies to inform their non-financial statements and to identify material non-financial information to be integrated in their financial reports. And ultimately, the corporate responses and CDP scores are used by investors to engage with their investor relations, investee companies to determine sustainability performance of portfolios and other financial products and services. And of course, to ultimately inform their investment decisions will be used by and will be used for own reporting. I would like to very briefly introduce a mapping document that we have prepared to basically guide our stakeholders, so companies, investors, also cities and regions, and policymakers and supervisors through what CDP data can support them with towards all the policies under the EU Sustainable Finance Action Plan. And we are currently updating this document. And on this slide, you basically see the first section of this mapping document, CDP and Sustainable Finance Action Plan, which provides concrete technical guidance for companies, investors, cities and regions and policymakers, and how they can use their own and others' disclosures to CDP for regulatory disclosure requirements and respectively also for impact assessment of policies. And this slide shows which data points from their own disclosure companies can use for reporting under the Non-Financial Reporting Directive. So it's a very concrete technical guidance document. And on the next slide, you can see the second part of that document, which consists of brief summaries of all the policies under the EU Action Plan on Sustainable Finance, which had been published in March 2018, by the way. And here you can see the part, a screenshot of under the action number 9 of the action plan. This is the part where the action plan addresses the Non-Financial Reporting Directive, as well as other policies under the Corporate Reporting Regulatory Framework, such as you can see, the IFRS regulation. So I encourage you to have a look. We're going to share that link as well, and I hope you will find this useful. And we can go to my last slide, where I will just thank you for your participation and attention. And I will now hand over to Gemma for the second part of the presentation.
Thank you, Miriam. And I think that gave a very good overview of all of the things that are happening in the EU at the moment, which we know that there's lots of things going on. So hopefully Miriam's been able to demonstrate to you some of the key elements. I'm now going to talk about the handbook that we launched yesterday. But to start off with, for those of you who have not seen or know much about CDSB, a quick overview: we are the Climate Disclosure Standards Board. We are a consortium of 9 environmental and business NGOs. You can see on the slide there the organisations that are on our board, including CDP, the SASB, the World Business Council for Sustainable Development, and we are chaired by the World Economic Forum. We are also supported by a technical working group of over 40 experts across a variety of fields, including accountants, companies, and other people who work in NGOs, and also academics. Next slide, please. The CDSB framework is a framework that was designed using accounting principles and accounting standards as the inspiration. It includes 7 principles and 12 recommended requirements. So the 7 principles are the how to report this information, including things like comparability and consistency, and then the reporting requirements tell you what to report. As Miriam mentioned before, just like CDP, the CDSB framework is referenced in the EU non-binding guidelines. So I'm going to give you a whirlwind tour of the handbook that we launched yesterday. So I'm going to give you some overview of what we did and some of the examples that we had. The handbook is an update of our 2016 handbook, which was really well received. A lot of companies said it was really helpful to see what practice looked like. And so this time we wanted to kind of update that report and see how has reporting changed and what does best practice look like today. We looked at a number of companies across a range of sectors, and we tried to make sure that we had a good sample from across the EU. So on the slide, you can see all the companies that we included. They're not exhaustive. There were loads of other companies that do have good practice, but we wanted to make sure that we had a good range from different sectors and geographies. And the examples are presented in the report in 5 sections, each section corresponding to one of the content elements outlined in the directive. And I'll be going through now each of the content elements and talking through some of the examples that we had. So let's start with A, and that's a brief description of the undertaking's business model. The following examples, and the examples that we have in the handbook, demonstrate and illustrate the way in which some companies communicate their business model. And a lot of these take inspiration and follow the international integrated reporting frameworks, input, activities, output, outcome model. Some people call it the octopus model, which describes how various capitals are then transformed by the business through the business model. The Commission's guidelines, non-binding guidelines, describe the overview and say that companies should be talking about the business model as an overview of how companies operate and the rationale of its structure by describing how it transforms inputs into outputs through its business activities. So one of the kind of key areas that we think companies should be looking at is, and some of our recommendations when we were looking at the sample, is applying that integrated frameworks model, but also linking the model back to the company's strategy and policies to provide a broad understanding of how the company operates and to describe the contextual information about the main trends and facts that could affect the business, as this in particular helps justify and set the context for the company's policies and strategies. If we turn to the next slide, I'll give you an example that we've taken out of the handbook, and this is from Volvo. Volvo's report, and especially their section on business model, is particularly good. It's in a huge amount of depth, and we wanted to just pull out this one extract in particular, which focuses on the contextual information around the main trends, macro trends, sector-specific trends, and factors that may affect their future development. They then, in this paragraph, and I know you can't read what's on the slide, I know it's too small to be able to see, but there are links, and I suggest you go to the handbook and have a look. You'll be able to read it in a bit more detail. But if you go further down in this section, Volvo also then describe how these trends are used to explain and justify the company's policies and strategies, and kind of give us an idea about what their future plans are. They then link their strategies to some of their KPIs and outcomes, and that again demonstrates the interconnectedness of all of this information. So it's often, and you'll notice a pattern in all of the examples, good practice is often where you're able to connect this information together and demonstrate through your KPIs how you're meeting your objectives and your strategies. So now taking a look at content element B, which is a description of the policies pursued in relation to those matters, including due diligence processes. I forgot to mention on the previous section that what we did in the handbook is we also mapped the non-financial reporting's requirements to the CDSB framework requirements, to the CDP climate change questionnaire, and to the TCFD recommendations. We did this so that you are able to report the information in a way that covers all of the standards and frameworks, and to demonstrate the synergies between all of these. Next, oh, sorry, not the next slide. So with the description of policies, what companies are asked to do is to describe what the company's approach is and the objectives and plans they have to address key non-financial aspects. So one of the things that we found particularly good from the examples that we had is companies outline the policies and include the rationale, including a materiality assessment and stakeholder engagement to demonstrate why they've decided to follow specific policies and how that then relates back to the strategy. So the difference between policy and strategy, the company's policy may be to try and be more environmentally aware of their impacts, and then the strategy is how they then plan to implement that. What are the actions that they're going to take in order to achieve those policies and follow those policies? So if we look at the example that we've pulled out for this particular example, and that's Royal DSM. Royal DSM in particular demonstrate their overall vision, the purpose, so that's their policy, and then links those policies to, links those visions to the policies and then again to the strategies. So they're linking all of this information, demonstrating how it all fits together and the interconnected elements of the disclosure. There is a description of the company's policies, which link back to some of the other initiatives that they're taking, and they talk briefly about how the policies then relate to performance, specifically focusing on some of the key areas that they're going to be focused on going forward. So then C is asking companies to then describe the outcomes of the policies that they've put forward. And we've already seen that a little bit from Royal DSM in the previous slide. So the outcomes should present the performance of the company against the policies that we've seen. And this information could be presented in either qualitative or in a quantitative way. And then that just depends on what your indicators are for success. In particular, our recommendations for good disclosure is to present the results next to the policies so that we can then connect those two together. So the readers are able to see these are what the company's policies are, and these are how they're currently performing against those. What we also found particularly good is where companies talk about the outcomes of the policies and then describe how these outcomes will then influence their future plans. So again, linking back and constantly showing how the company is evolving and demonstrating good practice. So as I mentioned just now, the outcomes could be described in a qualitative or quantitative way. So we've seen companies demonstrating the outcomes of the policies in graphs, but we've also seen a more narrative style, as you can see here from Daimler. So Daimler provide a really clear description of their target, and they link that to their current and future strategies. So you can see all of that information is together on that one page. The outcomes of these policies are summarized in that small section on the right-hand side of the screen. And then that also includes an explanation and justification of why the outcomes were as they were. So when companies are describing or talking about their outcomes, they should link back and talk about, include narrative about why their outcomes are as they are. This may be because of certain actions, certain trends that have happened, something external that has then impacted on their ability to perform. But having that additional context around the results is incredibly helpful. So looking at D, and this is principal risks related to all of these matters. I'm not going to read that whole section because it's quite detailed, but specifically, companies are required to disclose the principal risks, including some additional information about how they intend to manage and mitigate them. Now, for those of you who are familiar with the Task Force on Climate-Related Financial Disclosures will know that the Task Force centre a lot of their recommendations on risks and how companies are impacted by climate-specific risks, and then how they're planning to manage and mitigate those risks. So in particular, there is a clear link between the TCFD recommendations and the Non-Financial Reporting Directive on this particular element. Where we've seen practice, some of our recommendations for good practice are for a company to give an overview of their approach to risk management, thereby providing the context about how the company defines and manages risk. So specifically looking at the process for how risks are identified and how they are prioritized. We recognize that environmental issues may not always be principal risks, but we want to know some information about how was that determined. There are a huge range of environmental risks that companies could consider. And if you look at the CDSB framework, we go through various risks specific to environment. So looking at legal risks, reputational risks, market risks, and also environmental risks in terms of physical risks. Again, you may have noticed this is a theme that runs throughout the report. Companies that link the risks back to their policies and strategies are very successful. So in particular, demonstrating how the strategies take into consideration those specific risks, how they're adapting their strategy or changing their strategy in order to make sure that those risks don't adversely affect the business ability to create value. So to give you an example of a company that does this, and I think Mondi Group is actually a really good example across a lot of the core elements, but we specifically wanted to pull out their principal risk section because it's incredibly detailed. They start the section with a matrix that gives us some contextual information about how risks are assessed, and we can see there how they look at likelihood and impact to demonstrate which of the risks are more principal and more material. They then go through each of these risks, and they've numbered them so that we can easily find the risks that we want to look at. And each of them are then outlined in a bit more detail, including what the potential risk to the company is and ways in which the risks are monitored, mitigated, and assured. Climate change and environmental issues are featured quite heavily in Mondi Group's risks. Sometimes they are very specific, and sometimes they're integrated within other risk types. So last but not least, and this is the fifth core element, companies are asked to describe and provide their non-financial key performance indicators. And in particular, this can be done through, again, through narratives or by inclusion of specific indicators that demonstrate their performance. And which ones to choose and how you define them as key performance indicators depends on the company's policies and what they think is material. In particular, when we looked at the examples, we recommend that good practice should use indicators that are material and reflect on what the business activities and policies are. Companies should link those targets to a baseline and a timeline. I think one of the things that we were very surprised about when we were looking at this is the amount of indicators that are not linked to targets, and where there are targets, they don't always have a baseline or a timeline. And without that, it's really difficult for us to be able to understand how the company is performing and how progress is managed and measured and monitored. In particular, companies, if you're stuck on what indicators you should be using, we suggest that you look at the indicators defined by CDP, GRI, and SASB, and understand kind of which elements are most relevant to your company. So an example here that we pulled out was from Bankia. And in particular, Bankia provide environmental information around energy, water consumption, but also greenhouse gas emissions. So we see here that the indicators are defined, and then the performance and the results are linked, and they use multiple years, so 2016, 2017, 2018, so that we were able to assess and look at trend. We can look at the trends and how performance across the years is going. They also provide, and I think this is really key for the key performance indicators, they also provide additional narrative underneath each of the tables that give us a little bit more context. So in some cases, they tell us, they justify why the results are as they are. They give us some information about the methodologies that they used and some of the assumptions that they used. In terms of their greenhouse gas emissions, they break down the emissions into scope 1, scope 2, scope 3, which is, of course, good practice using the GHG protocol. And again, they provide that additional information to explain what where this information's come from, how they've collected the data, and how they've measured it. So, as I said, this was going to be a whirlwind of all of the examples. We have a lot more examples in the handbook, and I do strongly recommend that you take a look at their handbook. And in terms of kind of concluding this part, from all of the reports that we looked at, we pulled out 4 kind of key tips for effective disclosure. Unsurprisingly, based on some of the things that I've said in the slide so far, disclosures should be connected and coherent. And I think we've talked about making sure that even within the non-financial reporting directive, you have the elements A, B, C, D, and E, but they don't necessarily, or they shouldn't necessarily be reported as separate sections. A lot of them are interconnected. So having your policies and your strategies alongside the outcomes, including the KPIs to demonstrate performance, are all good practice. And where we've seen companies connecting that information is really important. We also, when we talk about connecting information, is linking the environmental or the kind of non-financial elements that are described when disclosing against the non-financial reporting directive, but connecting that information to the corporate strategy and the financial information within the report. It's always surprising to us when we're reading reports and the strategies and policies around environment state that environmental issues are core to the business and sustainability is core to the business, but then it's not even mentioned in the overall corporate strategy. So if there is no connection to the overall corporate strategy, we would then assume by reading that sustainability is thought about within the company as a separate issue. The report should be clear and concise. Hopefully we've demonstrated a number of ways in which you can, rather than duplicating information, clearly show where the information can fit together. Providing visuals like graphs and diagrams are always very helpful. And going beyond climate change, I think the non-financial reporting directive doesn't specify climate. They talk about environmental reporting as a whole. So rather than just looking at emissions reduction and emissions reduction targets and what companies are doing to do that, we should also be looking at deforestation, water, other natural capital elements and environmental issues. And as I mentioned at the beginning of my presentation, applying guiding principles for effective disclosure is important. So the CDSB framework outlined our 7 guiding principles, and it's to make sure that information is relevant material, it's faithfully represented, it's connected again with other information. This information has to be consistent across years and comparable with other organisations within your sector in particular. to make sure the information is clear, understandable, that it's verifiable, and that it's forward-looking. And on that note, that brings me to the end of my presentation. So I'll pass back now to Julia.
Thank you very much, Gemma. Thank you, Miriam. That was fantastic, the presentations from both of you. Now, just before we jump to the Q&A, we did run a poll, and around half of our participants took part in it. The question was, does your company currently report climate change and environmental information in the annual report? And most people, 39%, have answered yes, 15% no, and about 2% intend to do so in the next 3 years. Now we have a couple of questions, and I believe they're addressed to Gemma. First of all, there's a set of questions. Shouldn't targets be quantitative? And it's interesting to note, says Monica, that financed emissions are not reflected in Scope 3. Then also there is a comment 3 of them. Previous comment was for Bankia, and for the 3 banks in the sample, would be interesting to comment on the targets, KPIs of Annex 1, NFRD, green asset ratio, brown asset ratio. Gemma, would you like to comment on these questions?
Yes, absolutely. Thank you, Julia. And thank you for your questions and for your comments. I think firstly, what we'd like to note is that none of the examples within the guide are perfect. And I think perfect disclosure doesn't quite exist. Yeah, what we're looking at is specific elements of good practice. So the Bankia example, the reason we pulled out that particular example is because of the way that they've clearly demonstrated in a really kind of simple way through their table the elements around water, energy, and emissions. I think we're often quite surprised by the way in which KPIs and performance is disclosed in annual reports. I think for us, we would assume that it would be described in tables or in graphs, but that's not always the case. So we wanted to pull out the Bankia example because of the way in which they've presented that information, and also the additional information around their methodology and the narrative that they provide under those tables to give us a little bit of context around what they've pulled out. Certainly, in a lot of cases, additional information is required. So it's really useful to kind of look at the examples in that way. And in terms of shouldn't targets be quantitative? Yes, ideally. Targets should be quantitative so that we are able to effectively measure them and monitor them and to be able to demonstrate progress. But again, it's not always necessarily the case that they can be quantitative. It'll depend on what specific element you're looking at. So if we are talking about emissions reduction, that's quite an easy one to then have a specific target to. If we're looking at water usage or water efficiency, then that's quite easy to have a quantitative target to. So ideally, yes, targets should be quantitative.
Thank you. We have another question. Will there be a guideline on the SG part of the ESG? Would you look into expanding?
Again, that's a fantastic question. At the moment, so even though the guide focuses on environment, all of the elements are also all of the elements that we pull out and all of the recommendations could be applied to the S and the G. So in the NFR, they pull out, as Miriam said in her presentation, different topics, kind of key themes that companies should be looking at. And environment is just one of those. There's also social issues, human rights, bribery, and corruption. So all of the kind of core elements and the core recommendations that we have in the report can also be applied to the S and the G.
Thank you very much. We have another question, which is for Miriam. So, Vice President of the European Commission, Valdis Dombrovskis, recently tasked EFRAG, the Europe Financial Reporting Advisory Group, to facilitate the development of European standards on non-financial reporting. How will these standards fit within the non-financial reporting directive?
Yeah, that's also indeed a very good question. A very recent Commission indeed. The European Commission, so it's important, I think the first thing to note is that this announcement on tasking EFRAG to initiate a process, right, to sort of kick that off the ground, is something that is complementary to the regulatory framework. So the European Commission looks at a couple of policies that are quite crucial for them to achieve the Union's climate and environmental goals, and also notably, obviously, the climate law, carbon neutrality by 2050. And they have in place corporate reporting regulation and notably, obviously, the non-financial reporting directive that is currently under revision. Then we have the EU taxonomy regulation, which is not only sets out disclosure requirements on the sort of, let's say, the alignment of investor portfolios with sustainable activities, but also targets and includes the same scope of large companies also required to disclose on their sustainability activities. And to complement that, the Commission has taken the lead, I think this is probably the right way to put it, in setting out a work to be done on harmonizing indeed existing frameworks and standards to ultimately ensure that non-financial reporting fits the purpose or fits the objective of the European Union as a whole.
Thank you very much. There is another question regarding supply chain. So the revision of the non-financial reporting directive might lead to a clearer reporting requirements regarding entire supply chains. Some people argue that this would lead to too much of a reporting burden for small companies. What is CDP's take on supply chain reporting? That is for you, Miriam, I believe.
Yeah, thank you. There is indeed. I mean, this is an ongoing, I guess, also thing. We hear sort of what about SMEs? I think the way forward also for the Commission, whereas now we have I think the wording is companies have to report in their business relations. Is for sure to tackle and to strengthen disclosures and reporting throughout entire supply chains. This is actually also making a little bit back the link to the questions we had on targets, because ultimately, if I just take the example of greenhouse gas emissions, where we can, where we still have the most mature reporting from companies, a lot of companies are actually very good in reporting scope 1, 2, and even 3, scope 3 emissions. And however, we need definitely to strengthen the disclosures and the matureness of supply chain reporting. And the way how CDP tackles this is to also tackle that there is no overwhelming reporting burden, obviously, for companies in general, and also for not for very small companies. So we are still talking about medium-sized companies rather than the example often used, like the bakery around the corner is obviously not subject to any reporting under the non-financial reporting directive, and also not requested through CDP's supply chain disclosures. But what we see is that we do apply at CDP sort of a hook that is indeed to lever the purchasing power of large corporates who are themselves requested by their investors to disclose, and who would then go out to their suppliers, again using the CDP framework, to ask them to fill in the very same questionnaires. what we see is, first of all, those are often not very small companies. It's quite, it can even be like listed companies and very large companies as well. And the other effect that we strengthen is that one company which responds as a supplier often doesn't respond only to one client, but to many of those. I think to give you an example for the European jurisdiction, we do have 51 companies, I think, requesting in Europe, headquartered in Europe, requesting their suppliers through our system to disclose their environmental information. Companies like L'Oreal, BMW, Unilever, and they do actually in these companies request more than 4,000 companies across more than 80 countries to respond to the questionnaires. And on the other way around, those 4,000 companies obviously do use their disclosures to respond to the request of many of their clients. I think this is a little bit the smart ways that I would hope the regulation could drive to not increase reporting burden, to have like very smart entire supply chain disclosure chains, so to say.
Thank you very much. I'm afraid this is all we have time for today. I'd like to thank our speakers for giving amazing presentations today. I'd like to thank our guests for participating and asking their questions. And if there were any questions that we were not able to address, I encourage you to write to us via email info@cdsb.net. I also encourage you to go to our website and to download the handbook to get more context, more insight into what the environmental reporting looks like in the European Union. And special thanks to the EU Live program that made this webinar and the project possible.